how to filter and discover which Nigerian stocks are good for investing or trading. Now, note this caption. I want to teach you how you can filter. When you filter something, it means you're trying to separate it from maybe the unwanted parts. So here, I want to teach you how to filter and discover which Nigerian stocks are good for trading or investing. So meaning that it's not all the stocks that are listed in the Nigerian stock market that are actually good for trading. And it's not all the stocks that are good for investing. Some are good for trading, while others are good for investing. And there are some that are also qualifies, that are also qualified for both trading and investing. Now, when I review portfolio, I remember sometimes last week, I was reviewing a portfolio under my coaching section. And then the first thing I look at all the stocks that one of my members have in his portfolio. And then the question I always ask is, why did you buy the stock? Irrespective of whether the company has a good fundamental or not. This is the first question I always ask. Why did you buy CES? Why did you buy NACO? Why did you buy this? Why did you buy FCMB? Why did you buy Zenith? Why did you buy Oil? Why did you buy Caverton? Why did you buy? So every stocks I see, please, the stocks I'm mentioning right here are just random stocks. They are not actually his pick. So please be very careful when you pick some of the stocks I mentioned in this video. They are not by recommendation. Now, when I ask these questions, I wanted a specific answer. I don't want plenty stories. And I even try to let him know that you don't have to share this story around each of these topics. Because by the time you start sharing stories, at the end of the day, we have spent almost 1 hour, 2 hours, and have not achieved the essence of this session. So I wanted one thing. I wanted to tell him, oh, tell me, oh, I bought this stock for trading. I bought for investing. I bought for trading. Why? Because it's important. Where you will know whether a stock is good for trading or investing is when their prices are going down. That's where you would know, that's where you will appreciate this particular course, this particular video that I'm sharing with you, because you need to know whether you bought a stock for trading. Because how you react to a stock dip when it's going down will be determined by these two, whether it is for investing or trading. Why? Because when you buy a stock for investing, dip should be welcome. When you buy a stock for trading, dip shouldn't be welcome. So this is exactly what you'll be learning in this video course. So these insights will help you find the exact companies you should buy for short term and another for long term. That means when you go to the market because you want to buy a stock, in your head, you already have a defined answer. You already have a defined purpose. So the question is, oh, this money I have right now, should I trade it or invest it? Now, if I'm going to trade it, it means I want to hold for a short term. That means the type of stock I should be buying should be a stock that qualified as a stock for trading. Now, if I'm going to invest this money, maybe I have a plan to invest this money for a long time because I don't think I will probably need the money in the next 3 to 5 years, but I don't want to keep the money in the bank. I want to invest it and also collect dividend on it. Then it means that I should look at stocks that qualify for investing. So you shouldn't go to the market and then you are now listening to your broker and you are picking stocks randomly simply because they just released good financials. Because a stock has just released good results does not automatically make it good for trading or investing. No. So be specific when you want to buy a stock. Am I buying this stock for trading or am I buying for investing? Because when you are able to answer that question, it will help you know how to manage yourself, how to manage your emotion when the price of the stock is coming down. Because the truth, many of us are yet to accept in this market, is stock price always deep. But how you behave depends on whether it's investing or trading. Now, even if you buy the stock for trading and it's going down, please go to the description section of this video. I'm going to post a link there. where you would see what to do when your stock is going down. I also posted a video. Those so meaning you don't just rush into sell because the stock are just deep. You need to go check the video. And I use one stock as an instance. And since I posted that video, that particular stock had stabilized from the price it dipped to. Why? Because there was no reason why I should sell that stock despite the dip, because nothing is wrong. So whether I should sell that particular course depend on stock, I mean, sorry, depend on whether it meets the criteria to know whether a stock is a sell or not, even when the price is going down. Why? Because I make sure I buy only bouncing ball and not falling knife. So I will post a video link in my description. Go watch that video. When you buy a stock for trading and the price is going down, what should you do? What should you do? Should I rush to sell out of emotion? What if you sell and the price start going up again? So there are things you need to check. Please, it's very important. I'll post a link to watch that particular video. If you missed that video or this is the first time you're watching this particular video, you're coming to my channel, please hit the subscription button, turn on notification bell so that when I release new videos like this, you would also get notified and then see the insights and ideas I'm sharing at that moment. Now, what you're seeing right now is a course that will teach you how to separate stocks, how to know which one is good for trading, which one is good for investing, so that you don't go to the market and gamble. Because when you buy a stock, sometimes when I ask people, why did you buy a stock? The first thing I want to know, the first thing I want to hear is I bought for trading and investing. Now, or trade or investing. Now, or it could be both. Yes, fine. But then you need to be specific. Most of the times, you have to specify whether it's for trading or investing. Most of the time. Because when you're buying a stock for trading and investing, that is dividend growth stock. And I just shared a video on dividend investing. If you want to buy a stock for both investing and trading, that means you want to buy a stock that will appreciate and also reward you for being a shareholder via dividend. Then you're looking at a dividend growth stock. So a stock that qualifies as dividend growth stock most likely be for investing and trading. Meaning, for investing, they are paying you cash dividends. For trading, their share price is also going up. Why? Because of the good fundamentals and the fact that the stock is still cheap. So in this video, I'm going to share insights on how to find the exact companies you should be buying for short term and long term. The short term is the one for trading, then the long term is the one for investing. Now, the big lesson here is that at the end of this video, you will learn how and which stocks to buy on dip. You will learn how and which stocks to buy on dip. That means when the market dips, when you see some stocks going down, you take advantage of that opportunity to buy a lot of stock. Let me share something very important with you. There were times when Zenith Bank stock went down and touched a low of let me see, I want to check my charts to find out the period. Yes, this is it here. Now look at the stock like Zenith Bank. Now these guys went down from 31 from J January 2018 to touch a low of 12 naira. 12 naira from 31 to 12 naira. Now, for someone like you, um what is your opinion on this stock? What do you think? Now, if you have this knowledge I'm about to share with you, you would have seen Zenith Bank as a stock that you should have bought at this price. Why? Because if Zenith Bank has value, if Zenith Bank passes all the checklists of investing, and the company has been paying dividend consistently, this would have been a perfect time to buy Zenith Bank. Why? Because you are buying them for investing, because they pass all the checklists of a stock you should invest in. So price dip should be welcome. price dip should be welcome. Now, this opportunity had showed up in 2016, and now we saw the second one in 2018. But I don't know when this might probably show up again because the kind of result banks are releasing right now, they are massive. So the idea is that when you see a good stock tanking, when you see a good stock go down, what should you do? Because it has value, then it means you should quickly pick it up immediately, especially stocks that their dividend yield is very attractive. Especially stocks that are dividend yield is very, very attractive. So that's the essence of this video. I want to show you how to know which stocks to buy on dip, because deep buying is actually profitable if you do it well. But then you need to know how to separate this bouncing ball from the falling knife, because if you try to catch the falling knife, that's danger. These are stocks that are bouncing, that are dipping, and then you don't know the bottom. It's like bottomless stock. But stocks that are bouncing ball and stocks that you know will most likely bounce back. And what is that confidence that you are going to build to help you buy that stock during dip is what this is value. So I'm also going to help you understand value in the Nigerian stock market. Many of us don't understand value. Many of us are focused on price, not knowing that price and value are not the same. If you focus on price, you may not make money in the market. Your emotion will not allow you. In short, you will be impatient. Why? Because price changes. There are times price will move in such a way that you'll be tempted to buy. There is also a way price will move and you'll be tempted to sell. But when you focus on value, value would help you control your emotion in the market. Value will help you remain calm even when prices are going down. Why? Because in value, at the end of the day, price will always catch up with value. Do you see that? Value is like a magnet. So no matter how far the price of a stock moves away from its value, it will get to a point where the price will be attracted to the value. So it's like you keeping magnets and then you are trying to get a metal close to it. It will attract it. So the point I'm trying to share is just let price do whatever it wants to do. Let it go to anywhere at the end of the day. So value is like home. No matter where you go to work, you go to the office, you go to see friends, you go out, you go to different places, but at the end of the day, what happens? You will come back to your house. So value is like a home, is the home of every stock. So your point is learn to find the home of this stock, learn to find value, learn to understand where is the value of this stock. Do you understand? And the value of that stock is the fundamentals. Meaning, if you pick a stock with a solid fundamentals, based on what I'm going to share with you right here, no matter what price is doing, at the end of the day, price will always come back home. That means price will always catch up with value. Now, when you understand this, you will not be disturbed. You will never, in short, this is the point where you have killed your emotion completely in the market. This is the point where you are disconnected from your emotion market. When I talked about UCAP, in my video on whether you should buy UCAP on deep and what to watch out for when a stock is going down, I was focused on value. I didn't, if you go back to that video, I wasn't talking about, oh, UCAP has dipped, oh, I'm worried. No, I first looked at value. Did this stock have, are there value to watch out for in this stock? Is this stock carrying value? And from the analysis, yes, UCAP was carrying value. So UCAP was carrying value. Imagine a stock that had dipped from 24 down to 2016. So it was carrying value. So that was why I had to quickly um, calm everybody down to hold on to their stock because it carried a lot of value. Now, at the end of the day, no matter what price is doing, price will always come back home. That means price will always catch up with value. But when you focused on price, you have lost value. And then what happened? That's a risk. Even the biggest risk in the market right now, the biggest risk in the stock market right now is not that you bought a stock at the top. It's not that you bought a stock at the bottom. Is that you focused on price and not value. So, and funny enough, a lot of people don't know this. A lot of people have lost this knowledge, this simple knowledge that will save them from making loss in the market. They have focused on value, sorry, on price. And let me tell you how they focus on price. They will go to the stock market, and then they are looking at top gainers. I'm just telling you one easier way to focus on price. They will go to the stock market. Oh, top gainer for the week, top gainer for the month. Oh, top losers for the week. Now they buy more of top gainers for the week, right? And then they sell more of top losers for the week. Now the following week, top gainers for this week might not become top losers, and top losers the previous week might not become top gainers, and then they are confused. They will switch again, and then that's how they keep. And then while you are doing that, you have ensured you have lost complete value. But when you focus on value, whether the stock was top gainer for the week or top loser for the week, at the end of the day, price will always catch up with value. So focus on value. That's the big lesson that you're going to learn right here, which is the essence of this video. I want to teach you how to focus on value in the market so that when you buy a stock for long term or you buy a stock for trading, you know exactly why you have bought that stock. So irrespective of what price is doing, you are holding on because at the end of the day, again, the simple factor that is responsible for your results or whether you will make money in the market or not is actually patience. It is not strategy that makes you money in the market. It is patience that makes you money. Don't let anybody deceive you. Don't let anybody tell you, oh, if you we have the best strategy in the market. Yes, strategy is good, but you know what? Strategy is just 10% of the process. Patience is 90%. If you buy a good stock and the price go down, if you're not patient enough, you will sell at a loss. So what is actually responsible for the money you have made in the market is patience. Sometimes you see people, they'll tell you, oh, I left my stock for almost 3 years, 4 years. I've not even checked. And when I have a friend, he bought a stock like, is it 5 years ago? And all the stocks he bought are doing 100% plus. Now, not like he was monitoring his account. He left them, he closed his account, he sure he got busy doing other things. Maybe he got involved in crypto markets and then he forgot, like, let me just leave stock. When he opened the stock account, he was surprised. You know what I told him? I told him that if he had been watching that stock every now and then, he wouldn't have made up to that amount. Why? Because patience would not have allowed him to hold on to that stock. It's the emotion, his emotion, I mean, wouldn't have allowed him to hold that stock. Maybe he would have sold his stock at 30%, 40%. But because he left the market, because he stayed away from the stock, because he didn't focus on price, he wasn't looking at the fluctuations. That was why. So indirectly, it shows him how patient is responsible for a larger portion of that profit. So that is where this big lesson is coming from. I want to teach you how to focus on value and exercise patience in the market. So if you're able to catch these two, you are on your way. You are on your way to owning the best stock in the market. And at the end of the day, there's nothing stopping you from making money in this market. So you will see how I am not coming online to teach you how to make 100% overnight, but showing you the principle behind it so that you can build sustainable profit and wealth in the market. Sustainable profit and wealth in the market. If you're yet to join our community, kindly go to glofolio.com. Glofolio.com. That's our community. Glofolio, this is it here. Go to glofolio.com. For some of you that have been asking me how to join the community, so this is it here. Go to glofolio.com. You click on Glofolio Investment Club and then register right here. When you register, you'll be able to subscribe, or you can as well download our app. So we actually have a mobile app, but only for Android users. This is it here. Glofolio is on Play Store. Look at it right here, Google Play Store. So you can download our mobile app. So if you're here to join our community, kindly follow this process to join our community. Seamless. You can go to the web, quickly download the app, or go to the Play Store, download the app. I mean, go to the web, log in, register. It's already integrated with Paystack, so you can subscribe from here. So let's continue. Now, how is trading and investment different? I've shared this multiple times, and I want to talk about it again. Now, trading is more of short term. You buy a stock to make money from capital appreciation, while investment is for long term. You buy a stock for cash dividends. Now, if you had bought into a good stock too, over time, the price of the stock should also appreciate. You understand? Because if a company is delivering good results year on year, then you don't just invest for cash dividend. You should also experience some level of capital appreciation on that particular stock, because I see no reason why a good stock should tank if you have hold them for 5 years. So for me, I think investment is not just for cash dividend alone, but also long-term capital appreciation. Now, what makes it an investment is that you are holding it for a long time. But then for trading, you are holding for a short term. So they are not the same. So trading, like I always say, it's like dating, while investment is like marriage. So in one, you plan to stay for a short while. Now there are stocks that might probably good for trading and suddenly it passes the checklist for investment too. So that's where dating become marriage. But there are also stocks that are good for investment. So that's like you're holding them for a long time. Now, before you buy a stock for trading, the type of analysis you carry out, here's the difference. The type of analysis you carry out when you want to trade a stock is totally different from investment. So most people, they use the same approach. That is the big mistake. That's the big error. They use the same approach on a stock they want to trade, on another stock they want to invest in. How can you be using the same approach? Let me share this funny example. It looks funny, but it's easier for us to understand it faster. Now, you have someone that you want to date and you have someone that you want to marry. Do you understand? Now, the type of analysis you carry out on both of them are not the same. Now, for someone who you want to date, you're just looking to understand some basic features, and then just for that, do you understand? Now, I'm using this analysis just to explain this process. I'm not a counselor, please. Now, the other person who you want to marry, you look at the kind of research you're going to carry out. It's going to be a lot more deeper. Why? Because you plan to stay with this person for a long time. So the type of analysis will be intense, extensive, deeper, and then you will make sure you get all the facts right before you go ahead to do that. So now, imagine people that are now using the same principle on dating, and then they want to use it on marriage. It wouldn't work. It doesn't make sense. I'm sure you get that point. So that's exactly what happened here. You can't use the same approach to buy a stock for trading and then apply it to another stock for investing. Does it make sense? No. So you need to know, that's where the separation comes in. You need to know whether this stock, does it pass the checklist of trading or investing? The moment a stock fails the checklist for investing, then you should be looking at it whether it's good for trading. And there are stocks that may not even be qualified for either trading or investing at all. That one, they are no go area. We have a lot of stocks like that in the Nigerian market. They are not good for trading. They are not good for investing. Stay away completely. This one, they call it dead stock. If you go there, you are stuck for life. Yes, nobody's even going to. The funniest thing is that nobody's going to buy stock from you. So you just watch your money and you can't do anything about it. So those ones completely stay away from them. So it's also good for you to know whether they are good for investing, even if they don't qualify for trading. So don't always say that, oh, because a stock doesn't qualify for trading, then it automatically is for investment, or because it doesn't qualify for investment, then it's for trading. No, there are stocks that actually fails the checklist of both investing and trading. So that's why you must carry out the detailed check. Make sure they passes the. So if it doesn't qualify for trading, check if it's for investment. If it doesn't qualify for investment, forget about it. So meaning that there are categories of stock that you should not even touch at all in the market. Most people, they just want to buy. I want to buy. I like this stock. No, no. There are times you buy a stock. Now, many times you see that a lot of people come to our community. Oh, my parents bought stock A, stock B, and now I cannot recover it. I was just cleaning the house and I saw a share certificate. How do I recover it? Sorry. One of the major risks of being a shareholder of a company, let me tell you, something that many people are not, in short, I think a lot of people have forgotten this part. One of the major risks of being a shareholder, especially an ordinary shareholder, they say it's ordinary. There are different shareholders in the company. You have the preference shareholders, we have the ordinary shareholders. See, one of the major risks of an ordinary shareholder is that you also take a part, you also share in the risk of both profit and loss. Profit or loss. So if the company declares profit, you're part of it. If the company declare loss, you also take a share of the loss. Don't expect dividend. If the company goes down, that is the loss. If the company goes down, you have lost your money. I'm sure this part is very, very new to many of you. Many of us that are new to this. This part is new. If the company go down, declare bankrupt, or the company can no longer survive again and the company collapse, all the ordinary shareholders are also going down the drain. So if you had shares in Skybank, don't come to my forum to tell me how do I recover my shares in Skybank. That money is gone completely. The only people that are rewarded, the only people that will be that their funds are going to be paid back to them are depositors, customers of the bank. Those are the people that are being protected. Those are the people that are being protected, and that's where NDIC comes in, Nigerian Deposit Insurance Corporation. They are only there to cover depositors, not ordinary shareholders. In short, the people that are first, that are going to be treated first, that are going to be given professional treatment are creditors. Who are the creditors of the bank? Let's pay them. If we cannot pay them what we have, let's liquidate our assets to raise cash. So if after paying them, there is nothing left for ordinary shareholders, forget it. So that's the biggest risk. So if you have not been told, or everybody is starting, go and buy shares, and nobody is telling you this truth, please hear it right now. One of the biggest risks of being an ordinary shareholder, because you are an ordinary shareholder in the company. So this is the reason you must carry out the detailed analysis. This is the reason you have to check whether the company is strong or not. Don't throw your money on any random company. So most of our parents were actually throwing their money on random companies. So that's why some of you get frustrated when you go back and then you try to recover the shares and then you say share is good, share is not good again. I can't recover my money. Which money are you going to recover? Your parents were not creditors to the bank. If your parents were customers, let's assume they were depositors, fine. Now, the other instance is if the company was acquired by another company, right? Now, that one is fine. If it was acquired by another company and then there was also provision for share exchange, that means for every share you own in the ones that is being acquired, you're going to get another share. Perfect. So sometimes you need to understand why the company collapsed. You understand? Number two, was it acquired? If it was acquired, then you can proceed with share recovery. Okay, my parents had 10,000 units of these shares. Now, from the information, I see that for every 1,000, we're going to get 20. So if they own 10,000, this is what I expect us to have, which is 200. So my question now is, how do I recover the 200 units in the new company? That means the company that acquired the own. These are reasonable questions you need to ask. Problem about investing in Nigerian stock in right now is that the knowledge gap is so wide. People have not been properly notified. And your stock exchange is not even doing enough to share this information with people so that they don't get discouraged. So one of the biggest risks of being a shareholder or an ordinary shareholder is that when the company collapses, if anything happens, your money is gone. So that's why you must carry out detailed check. So, and this happens when a company is not good for trading or investing. So any company that fails both checklists, please be careful. Now, I'm not saying you automatically lose your money if you already own stock that didn't meet the checklist. But the point is just be careful. You understand? Just be careful. Now, nobody is 100% perfect in the market, but I'm sharing the knowledge that would help you own the right stock, either on your trading portfolio or investment portfolio. So I hope this helps in differentiating trading and investing. So please, whatever information that I'm going to share right now, kindly note that it's for educational purposes only, and they're also based on my own personal opinion. So kindly do your due diligence before taking trade or investment decision. Please be careful. Kindly do your due diligence. I'm only sharing this to teach you, to educate you, and help you learn how to manage your portfolio properly. So let's move in. Now, I have a question. Now, look at these three stocks. We have Okomu, we have Caverton, and then Naco. So the question now is, which of these listed Nigerian stocks is good for trading, investing, or both? Now, this is one good question that many of us don't ask. When you have three stocks to buy, and then you have the cash power, you have the buying power. But you can't differentiate the one that is good for trading. In short, some of us will just buy all the three. Now, we don't know whether it's for short-term or long-term investment. We just heard that they are good. Let me tell you one truth. Now, some people might be arguing on a stock and they'll be arguing differently. You understand? Their opinion varied, like completely different, opposite each other, but they can be right. Yes. Can come here and tell you that Okomu is very good stock, like very good stock. Go and buy it. Another person can come here and say, no, Okomu is not good. No, 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 I can't buy right now. Now, don't jump on that conversation to say Okomu is not good or Okomu is good. Someone like me, if I find myself in the midst of that conversation, you know what I will ask the first person? Why did you say it's good? Are you a long-term investor or a short-term trader? Now, why did you say it's not good? Are you a long-term investor or a short-term trader? You need to understand the perspective. Now, the first person that is saying Okomu is good may be right for long-term investing. The other person that is saying Okomu is not good may also be right for short-term investing, meaning there are stocks that may be good for long-term investments, but not good for short-term trader. So you can see how both of them are right in their own way. Why? What makes it different? Perspective. Perspective. One is looking at it from a point of long-term investing, and he's right. The other one is looking at it from a point of short-term trading, and he's also right. So don't always assume that people are wrong. Don't be quick to judge people. Don't be quick to say you are wrong because they didn't agree with you. Understand perspective. It's just like normal argument. You can be arguing and you'll be right. The person will be arguing and the person will be right. Perspective. So you want your perspective about the stock. So I'm looking at it from the point of long-term investing, and it's perfect. Now, even if the stock was a top loser for the past 1 month, it still did not change my perspective as a long-term investor. Now, for you as a short-term trader, you can look at the stock and say, no, it doesn't qualify for trading because from my perspective as a short-term trader, this stock has been down in the last 1 month, it's been down in the last 6 months. Sentiment is negative, but for long-term investing, it's actually a good opportunity for me to buy more. So sometimes you need to understand perspective, and that's that perspective that you are about to learn in this. So here I'm giving you Okomu, Caverton, and Naco. Which of them? Now, if you tell me Okomu is good for long-term investing, do you have a checklist? Not just checklist. Don't share assumption with me. Tell me specific data, specific number that supports your opinion, so that when we apply the same number to another stock, we'll be able to get the same results. Now, when you follow the same principle, you will most likely be getting the same results. So if the numbers you have checked to confirm that Okomu is good for long term is okay and they are fine, can I use the same principle on another stock and then know whether it's actually good or not? Don't use guesswork for me, because if you guess, another person can come on board to guess, and they will have varying opinion. So look at that thing. Is it good for long-term investing or trading? Don't guess. Don't tell me, oh, it's good because I think. Do you have the numbers to punch and at the end of the day conclude that Caverton is good for investing or trading? Naco, is it good for trading? Is it good for investing? Is it good for both? Do you have the numbers to punch? Meaning, when you subject Naco to both investing, you subject Naco to both trading, they did pass the checklist. These are the things we want to learn right here. So don't learn to separate your emotion in the market. Learn to do the right thing in the market. You can do it yourself. So which of these listed stock is actually good for trading and investing or both? We will find out later on. We will definitely find out later on. Now, look at the criteria for picking a stock for investing. So let's talk about stock for investing. Remember, in investment, we plan to stay for a long time. You want to hold that stock for a long time. So if the stock didn't pass this particular checklist that I'm about to share with you right now, then my hands are no longer there again. I'm off completely. Before you put your hard-earned money in a stock for long term, make sure it passes all these checks. Number one check, growth check? Does it pass the growth check? I will share what constitutes a growth check. I'll share it with you. Does it pass the profitability check? Does it pass the debt exposure check? And then the liquidity level check. If a stock passes all these check, not one, because every check you see right here, they play a major role. They are very important. So don't say, oh, it passes the growth check. You fail the liquidity check. I'm off. I'm not buying. He must pass all, not one or two, not three. If he passes three and he failed one, I'm out. Let's assume a stock passes growth level check, passes profitability level check, passes debt exposure check, and fail the liquidity check. Liquidity check here is you're looking at the cash position of the company. And guess what? If a company starts running out of cash, what happens? This problem will start affecting the debt level check. It will start borrowing. Now, when it start borrowing, the debt exposure start increasing. And remember, when a company is exposed to debt, then its profit level would also be affected because for every money you make, every naira you make, you are expected to settle who? The creditors first, the debt holders. Now that means this debt problem is now spilling into profitability. So that way, the profit of the company is going down. Now, when the profit level of that company is going down, automatically the growth will be going down because what happened is that when you make a profit, you're supposed to pay your shareholders and reinvest the other one. So what actually drives growth is reinvestment when you reinvest a part of the profit. And where does the growth come from? Maybe from acquisition, investing in research, new products. So if you don't have that money to invest again, your growth will be affected. That is why you must go for stock that passes all the checklists, but not um, two or three. So all, you can see how just a problem at liquidity level has spilled into debt level, and from debt level, it has spilled into profitability and profitability. Now, when you fail to do this and you say, oh, you pass growth, you pass profitability, you pass debt level, and liquidity is well, it's okay, I can manage it. Now, the company stock might still be going up, but it's just a matter of time. The whole thing will be spilling. By the time it become obvious, it's already late. You can't do anything again. And then you now wonder why. But I thought I went through all the check. I thought the company passes. No, you fail to see liquidity. Now, that's why I always advise my members that whenever you want to invest in commercial paper, be careful. It's not all commercial paper that are good to invest in. Now, it's good that our investment bankers are doing a good job. That means before they even allow the company to come to the public to announce their commercial paper, they would have done a detailed check. They would have done all this check and then advise. That's why the company always appoint advisors. Do you understand? Are we ripe? Can we do this? Do we have the capacity to pay back? No, they would have done all the checks and all that. But then it's still good that you do your due diligence. That's why you hardly see the company fail to pay back the debt that or the money that's raised from commercial paper. Why? Because our advisors have done a good job. Kudos to them, and I really appreciate that. So, but you as an investor, you need to carry out your own check. So, liquidity level is very important. You start running out of cash. What happens? You borrow money. And when you start borrowing money, your debt level is increasing. You can see here. Now, if your debt level is increasing, you are exposed to interest rates. Now, by the time you make a profit, you also be paying part of the profit. So because debt level is increasing, interest is already also increasing. That means you're not making a lot of profit. Now, if you're not making a lot of profit, just a matter of time, your growth rate will be affected. Did you see? So that's why each of these numbers are very key. Growth rate, profitability, debt exposure, and liquidity. So if you want to invest in a company for a long time, make sure all these loopholes are fixed before you can say, yes, I want to put my money in this company. So let's look at the things that make up this checklist. Now we want to expand it. Now, here, we're looking at first one, the growth rate of a company. In that growth rate, we want to see consistent growth in revenue, profit, and cash flow. We want to see consistent growth in revenue, profit, and cash flow, meaning a company must continually grow its revenue, must continually declare profit, and that profit must translate to cash. Profit and cash are not the same. Even for you as an investor, when you check your account and you see that you're in profit, profit is like an unrealized cash. while cash is a realized profit. So don't assume that every company that makes profits are good to invest. Check if that profit is being translated to cash flow, because it is cash that you use to pay bill, not profit. If you want to settle your creditors today, from what do you use to pay them? You use your cash, you don't use your profit to settle them. You don't use your profit to settle them, you use your cash. That is why it's important that you look at what we call this debt servicing ratio. This is one of the most important thing I check in a company. That means I want to compare how much cash the company has generated from operation, cash flow from operation against interest expenses. So if the company is to pay its interest from its cash, can it? Yes, earnings interest cover can do the job for me, which is this interest cover ratio. But there's a limitation. This is just earnings. This where I'm looking at profit. In this interest cover, there are non-cash figure there. So that is why I pay attention to debt servicing ratio, because if the company is to pay from its cash, can it cover? Yes, if it can cover, it's good. So, and it's also a liquidity check. So we want to see consistent growth in revenue, profit, and cash flow. Conservative debt. Companies should not be too exposed to debt. So I like a company that debt to equity is below one. That means their capital structure is exposed to equity. When you look at the capital structure is made up of debt and equity. If you want to start a business today, how do you raise cash? From your own personal savings, that's equity. You can also borrow money, that's debt. So if the capital to start a business is exposed to debt more, that means you have borrowed more money than you brought in your own personal money. It's a risk. You can't invest in that kind of business. So I want to see how much, even investors, private equity investors, they do it. They will ask you how much of your money have you invested in this business. They want to be sure that you are interested, you are sure of this business you want to do. So low debt to equity is key for me. When low debt to equity is below one, it means that the company is funded by equity. That means they are not highly levered. Yeah, from the word we use in finance. Highly, that's leverage ratio, highly levered. Now, impressive interest coverage. That means the earnings that the money they are collecting, when they earn, you after you have generated your sales, you've seen your sales number, take out your direct costs, take out your necessary expenses and all that. Now, when you have what we call your operating profit, that's earnings before interest and tax. Now, when you compare that earnings to interest, interest is what you pay for being a debtor. If you owe for being a debtor, yes. When you borrow money, you pay interest on it. So we want to see whether you are generating enough earnings to cover up your interest. So we call it interest coverage. So this has to be checked, meaning that the company is paying off, is receiving, is generating a lot of earnings to cover up. And this most likely is tied to top line. This is tied to top line. We don't want to buy into a stock that is borrowing to pay. We want to buy into a stock that is growing its revenue to pay its debt, which is very good. Then profitability, net profit margin, very important. Profit margin. Now, one of the ways to check whether a company is competitive is its profit margin. Now, when you start a new business, I remember then in Nigeria when recharge card business was very, very profitable, was booming. Like you start a business today and then in 1 month you're making money. Now, by the time you start attracting competition, do you know the effect? Your profit margin will start going down. Why? Because you want to remain competitive. And one of the ways companies can be competitive is by reducing price because they want to attract customers. But when you're attracting customers at a reduced price, your profit is also going down. So if a company is able to raise its price, if a company is able to raise its price without losing demand, you understand, without attracting competition, what happened? Profit margin will be higher. So one of the ways to check whether a company is competitive is profit margin. Is profit margin. If a company is reporting high net profit year on year, then it means that this company must be selling essential products. Because it's only a company that is selling essential products that can increase price without losing customers and yet still declare profit. So profit margin is a key number to watch out for. Because if a company's profit margin is going down year on year, then it's a problem. That means it's attracting competition, and competition tends to reduce your sales number. Now, because you want to compete, you want to still be in the market, you're losing your price. Just like what is happening in the airline industry right now, where AP stepped in and then tried to reduce price to attract, and then others are now reducing price. The truth is that their net profit margin will be affected. So other airlines, their net profit margin will, because they have reduced their price. Imagine when you're buying tickets for almost 2 to 3 million because you want to fly from Lagos to London. Now you're buying at an average price of 900,000 naira. Their net profit will be, why? Because of competition. So that's why this profit margin is very key. Then they will also have return on equity. From a shareholder in your company, I want to see how much you're making on the equity, on the money that I have brought in. So return on equity is key. If a company is exposed to debt and its interest coverage ratio is nothing to say at all, be rest assured that this return on equity will be a lot more lower. So you can see how these numbers are connected. So that's why you must not ignore one. Don't say, oh, this one is not okay, but I like this one. Let me go with. No, everything has to be checked. You can see I marked yes, 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 yes. From top to bottom has to be yes. You are not coming to the market to pick a good stock. You're not coming to the market to pick the best stock. You're coming to the market to pick a great stock. It's only a great stock that is good for investments because it has everything checked. So return on equity is also there. Liquidity, now, here, with this is what we're looking at, the cash position of the company. Current ratio. First, can this company pay off its existing debts, the ones that are maturing in less than a year? You know, when you look at the debt level of a company, there is what we call the short-term or current liability, and there's also the non-current liability, which is a long term. Now, those ones that spills beyond a year, that's a long term. Now, these ones that are current, that are expiring in less than a year. Remember, every company has 12 months to report its financial period. So what happens to debts that are maturing in just 3 months, 4 months, 5 months, and not more than 12 months? Can this company pay them without borrowing? Why would the company go borrow to pay up its short-term obligations, its current liability? Now, it doesn't mean debt is bad. If debt is translating to higher profits, why not? But at the end of the day, first, if you want to know whether a debt is good or a company is using its debt very well, focus on this interest coverage. Interest coverage will tell you whether a company is in debt or not. If a company is borrowing, 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 borrowing. Now, I'm not saying that a company that is exposed to debt is not good. There are companies that, by virtue of the industry they belong to, they must borrow. Construction is number one. Construction number one. But then, if they are able to cover this interest with their earnings, perfect. That means they are using their debt very well. Now, at the end of the day, too, if they are also able to generate enough cash to pay these interest expenses, then it means debt servicing ratio is important. When you owe, you're supposed to service your debt. Now, how do you service your debt? You service your debt by paying them periodically. So the cash flow you have generated from operation right now, can it pay your debt without going to borrow? If you need to borrow money to pay your existing debt, it's a problem. It's a problem. So you can see how these numbers are connected. So all this has to be checked for me to say this company is good for long term. If a company doesn't meet this checklist, kindly run. So any stock you want to buy, make sure you subject that stock to this checklist. Make sure you submit that stuff to this checklist. How you will carry out these calculations to make your job easier, they are already on my course platform. I have a course, although I designed it specifically for US-based company, but then the numbers are still the same. The numbers are still applicable to any company in any part of the world. So if you go to my course platform, coachoge.com, you will see here how to invest in great US company. This is it here. How to invest in. So I talked about how to save yourself the stress of calculating the numbers, how to save yourself the stress of looking for each of the company financial statements. There's a single place to find them. And how do you carry out this checklist? How do you scan? How do you screen the market? So there are certain checklists you need. So before you start analyzing each stock, imagine you picking one stock after the other. It's going to be stressful. So how do you explore online tools, online financial calculators to be able to make your job easier? Just plug in the numbers and then to give you a list of stocks that passes the checklist, and then you just need to check one or two things and you're done. So rather than trying to look at all these stock one after the other or random pick stock, if you random pick three stocks and they don't meet your checklist, you will get tired, you get frustrated. So I just showed you the metrics, but then it's good for you to employ the necessary tools to make your job easier so that you don't make errors too. If you start punching calculator, what if you make mistakes? And then that might also affect your investment too. So you might end up picking the wrong company. So It's just a way of showing you what I do. You understand? When you want to pick a stock for long-term investment. Any stock that doesn't pass this checklist, please move that stock to the next part. I didn't say trade the stock because the stock itself still need to be subject to checklist for trading. If it doesn't make checklist for trading, then you should stay away from the company completely. So that means there are stocks that are not even good for investing or trading for now. Now, if they meet that checklist, then you can then give it a try again. Now, a stock may not be good for investment this year. Now, when they release financial next year, it might be good for investment. So don't always assume that when a stock is not good for investment this year, then that is the end of your analysis on that company's stock. So it's important you watch this video over and over again to always check whether your stock is good for investment or not. Let's look at Okomu Oil. Is Okomu Oil good for investment? Now, the result you're seeing right here is as at 2020. I actually recorded this video in 2024. So this assumes that I'm using the numbers up to 2023. Up to 2023. Remember, we're looking for long-term investment. So the question is Okomu Oil good for investment? Now, look at the numbers. Consistent growth in revenue, profit, and cash flow. Did it meet it? Yes. Okomu Oil has been growing its revenue consistently by 29.9%. The number of years I used is in my video course, so you can watch the video course. Now, consistent growth in revenue, profit, and cash flow. Okomu Oil has been growing revenue 29.9%, profit 19.4%, and cash flow 160%. Now, this number is not a single year number, multiple years. So you need to look at it from the long term. If I'm going to invest in a stock for a long time, I need to be sure that this company has been growing its revenue at least for a reasonable period of time. So that is what you have here. So did Okomu Oil pass our checklist? Yes. What's the debt level of Okomu Oil? 0.34. That means when you compare the debt level to equity, is actually low. That means the company is largely funded by equity. A lot of things make up the equity of a company. One, the money you and I are bringing in, which is the shareholders fund. Number two, the retained earnings of that company. When the company makes a profit year on year, it reinvests it back. So it also makes up the capital of that company, retained earnings of that company, and other factors. So you can check a company's financial statement to look at that. Now, impressive interest coverage, 10 times. 10 times. What does that mean? It means that the earnings Okomu is generating from its operation can cover the interest obligation 10 times. That is massive. Imagine a company not being exposed to debt, yet the little one is exposed to its earnings can cover it 10 times. That means Okomu can pay up his interest straight up. That makes it attractive, meaning that me as a shareholder, I am not worried because this company is not too exposed to debt. So every profit they make should come to me. Now, that's why if you look at the net profit margin, almost sitting at 27.49%. 27.49%. One of the disadvantages of high debt exposure is that it also affects your profit because a portion of your profit that should be paid to you as a shareholder, it's also being channeled to interest expenses. So that automatically reduces the bottom line. Now, when you hear me say bottom line and top line is the sales revenue, sales and revenue. The bottom line is the profit level. So please don't think it's a big English. Now, the return on equity on Okomu Oil is 56%. 56%. That means for every 1 naira that we bring into this company, they are generating 56 kobo. And that's very good. What is the liquidity level of Okomu Oil? The current cash position of the company, when you also look at the liquid assets, can pay up, can cover its current liability 1.09. So any figure above 1 is fine. Now, debt servicing ratio means if you look at the cash level of Okomu, you can actually use that cash level to cover up for its interest expenses 7 times. This is straight number, no stress. No stress. So is Okomu Oil good for long-term investment? This is it. It answers our question. So if one is planning to hold Okomu Oil for a long time, this number should tell you. But then, like I always say, are you buying Okomu Oil for dividend or are you buying for long-term capital appreciation? Even when you are investing in a company, you also need to ask yourself whether you're buying for dividend. Now, dividend is good because as you collect dividend, you can reinvest back in the company. So meaning that as long as the company still meets the checklist, you can continue to reinvest. Now, if is for long-term capital appreciation, is also good too. So meaning you plan to hold that company for a reasonable period of time. So if a company has been delivering good results like this, you shouldn't be sure, shouldn't be surprised if you see that a company like Okomu Oil has delivered long-term capital appreciation, can you see right here? But in between, there will always be volatility. But then look at how the company stock has appreciated significantly. In 2012, Okomu was selling for 21 naira. Look at how the company has rallied from 21. So that's from 2012 to 2023 or 2024. That's 11 years. Yes, 11 years, almost 11 or 12 years. It has moved from 17, from 21 naira to reach almost 214 naira. Why? Because of these impressive numbers. Because of this impressive number. You can see here, from 2020, 2019, 41 to reach. So when a company meets this checklist, the company delivers good result like this, you shouldn't be surprised when you see the share price experience capital appreciation over time. So that is why you should know whether a company is good for a stock. So if a company does not pass this checklist, put it on hold. Now, it doesn't mean when a stock doesn't pass checklist for investments, then it's for trading. A stock may not even meet both criteria. I'm saying that again. Please note this part that I just shared with you. So this is my result on Okomu Oil. You can always go to the financials. They are on Nigerian Stock Exchange website to do your own due diligence. Here, we have another stock. Is NACO good for investments? Is NACO good for investment? The same checklist, consistent growth in revenue, profit, and cash flow. Here, 23.78%, that's growth in revenue, profit 94%, cash flow 46%. Now, one thing I like about NACO is NACO actually is in a sector that they're enjoying what we call duopoly, NACO and Sky handling, Skyway. So if you look at it, these guys can increase their rates per kg. They provide logistics services to airline. They can increase their rates per kg and then you don't have any choice. So NACO is here, 23.78%, 94%. Now, look at the debt level of NACO. NACO is not even exposed, 0.17%. That means a larger portion, a significant portion of that structure is funded by what? Equity. So no wonder, look at the impressive interest coverage. That means this company is not even exposed to large interest, 48.67. So if you look at the earnings of NACO against their interest, that means whatever they are generating as earning, we now compare it with the interest obligations. That means the number that shows you how much it is due that is payable to their creditors. These earnings can cover that interest by 48.67%. Now, look at the profitability position of NACO. Net margin, that's profit margin, is what? 19.51%. Return on equity, 52.2%. 19.51%, 52.21%. Then look at the liquidity ratio of NACO, 1.43. That means if you look at the short-term obligations and compare with the cash in the bank, their receivables, assets you can quickly convert to cash in less than a year. They can use that to quickly pay off all their maturing obligations. Then debt servicing, cash flow against their interest, 23.23%. Sorry, 23 times, I mean. Meaning that the cash NACO is generating from operation, cash, they can use that cash to pay their interest 23 times. That means it's large. They have enough cash. So if they are to settle their creditors today, they are to clear all the interest obligations. This is it here. They can do that 23 times. So that means they have enough cash. So is NACO good for investments? It already says it. Now, just look at how I'm carrying out this checklist right here. Remember, these are not buy recommendations. NACO might be selling at a price. The setback of this analysis that I just shared with you right now is I didn't tell you whether NACO share is cheap or not. Because if you jump on NACO stock right now, what if it dips? So you need to know whether the company is fairly valued or undervalued or overvalued before you buy them. So I'm only sharing this to teach you how to check whether a stock is good for long-term investment or not. So the price you're paying now depends on whether it's cheap or not. Please note that this video is for education purpose. I'm doing this to educate you, to teach you how to know whether a stock is good for investment or trading. Any stock that hasn't passed this checklist, ignore. In trading, am I worried that the company is not exposed to debt or not? No, I shouldn't be. It's not my problem. I'm not holding this stock for a long time. I'm really interested in the things that drives price appreciation. So that's trading. They are different entirely. So this is it here. Now, for criteria to pick a stock for trading, I always look for juicy yield of at least 9 to 10%. Sorry, I think I missed something here. I think I missed something here. Now, sorry. I missed something right here. For trading, I look for solid growth in quarterly numbers. Now, in trading, I look for solid growth in quarterly numbers. Now, trading and investing are not the same. Uh, every week, I think, I don't know, but I have already unsubscribed from them. I don't want to mention the name of the broker. I receive recommendations and they tell you weekly recommendation. I know some of us can also relate with it. Your broker will be sending you weekly recommendation. And then when you look at the details of the stock they share, they'll be using criteria for long-term investing to recommend stock for weekly trading. Who does that? The was time I wrote a mail. I educated a customer service person that I understand you're a customer service person, but please forward this to your analyst. She did, and they reached out to me. I don't want to mention the name of the broker and all that. So they were calling for partnership, blah, blah, blah. Saying, no, if I'm going to partner with you, you guys are going to pay me XYZ amount because I was able to prove to them that I have reasonable members and what they are doing is wrong. They are using criteria for long-term investing to recommend stock because they want to make money from brokerage fee. Because they make money when you buy shares, whether you buy or sell it for profit, you know that problem. So they will always do things that will make you to trade because it's in the trading that they will make their own money. So when you are looking for numbers, criteria for key Nigerian stocks for trading, you don't look at this. These are not necessary. No, you focus on the quarterly results. The quarterly results. Now, part of the quarterly results are this. These are not all. These are not all. These are just parts of it. So if a stock doesn't meet my checklist for investing, these are the things I check. These are part of the things I check. Impressive growth on revenue, net income, and earnings per share. Look at it here. And then I also look at the sentiments of that company. These are not all. These are not all. So if I am holding a stock like Caverton for trading, I have a reason because it still meets my checklist for trading. So Caverton may not be good for investment because if you subject Caverton to all these checklists, you might probably see one area, one red flag. But then when I subject Caverton to trading, it actually meets my checklist for trading. So you can see how I picked them. Now, NACO might also be good for investment or trading, but Okomu OIl is good for investment. So you can see how I am able to answer each of these questions here. So when you're picking a stock, always know the one that is good for trading, know the one that is good for investing, and know the one that is good for both. Now for trading, I already have a detailed course on this part. If you want to learn more about picking stocks for short-term trading, Millionaire Stock Trader, it is one of my best courses when it comes to trading stock for short-term. Here, I will take you from ground up. From ground up, there are 3 checklists to know whether a stock is good for trading. This is the course here, Millionaire Stock Trader, right here. This is it here. Everything you need to know when it comes to trading a stock, from fundamental checklists to technical checklist and sentiment analysis. There are 3 types of analysis you need to carry out if you want to trade a stock. You can see here, fundamental analysis, we have sentiment analysis, and then you have technical analysis. Fundamental analysis will tell you what to buy. Sentiment will tell you whether investors are attracted to that company. Technical analysis will then tell you when, timing. Is it right for me to buy now? Is it emerging from oversold? Because in trading, you are looking at interplay between demand and supply in the market. If demand is more than supply, price will go up. If supply is more than demand, price will come down. So technical analysis is what you will use to check for demand and supply in the market to know whether this stock is about to pick up because of what? Rising demand, or going to dip because of what? Increasing supply in the market. So this is why you need to learn how to pick stocks for short-term trading. So in short-term trading, I've already reviewed all the strategy here. Part of it is what you're seeing right now, but how to use this number, detail check. So in this video, I dedicated each section. There's a section for fundamental analysis from top to bottom, practical. You will see the numbers, you will see how to pick them, you see what to compare. Then for the sentiment, I did that. For technical, I broke down the numbers, the technical checklist, the tools you need to know whether a stock is ripe for entry or not. So if you understand this, tell me why it will be difficult for you to know whether a stock is good for trading or investing. So with this now, you can easily separate a stock that is good for trading or investing. Like I said, once a stock fails this checklist for investing, then it shouldn't be on your list at all. Now, when you now subject it to trading, that's what you will know. If it fails this checklist for trading, automatically it's a no-go area for me. It's a no-go area for me. Now, for those that have been asking me how to join our community, it's very simple. Just go to glowfolio.com. Register at glowfolio.com. In that registration, there are 3 plans here. There's a basic plan, there is the standard, and there is the hybrid. From the word hybrid is for both. The basic is for Nigerian stock only. The standard is for US stock. Hybrid is for both. You can pay via Paystack. You can pay via Paystack, and then I think that's all. This is sorry, this is not part of it, please. Yes. So that's all. So I think I've shared enough value in this video, and I hope that going forward, you now know how to separate stock for investing and stock for trading.